All right. Hi, everybody, and Happy New Year. Welcome to our first call of 2026. If for whatever reason you have to drop off the call today, this is going to be recorded and posted on our website by the end of today. And you'll also receive an email with the recording tomorrow. So before we get started, we just have to remind you of a few things. So this call does not provide investment, tax, or legal advice. The information presented here is not specific to any individual's personal circumstances. The materials provided for general information and educational purposes based on publicly available information from sources believed to be reliable. We cannot assure the accuracy or completeness of this material. The information presented may change at any time and without notice.
Oh, thanks for that warm introduction, Carly. It's good to be back in the saddle here. Grace has led the last few quarterly calls in the most recent investor forum. Big thank you to everybody who came out to Buffalo, New York for that investor forum. It was our third one, and we're looking forward to hosting that again next year in Rochester. I know Peter's already been pulling together plans for a venue on that. Today, our format here is going to be a bit of a presentation in the beginning. We're going to go through a concept and a part of our portfolio management here at O'Keefe Stevens that we haven't talked about on these quarterly calls before. So we're going to talk about rising income, the history of this in our portfolio and where it is today with our rising income portfolio. Dominic's going to take us through some of the positions there, and we're going to tie that up with, how does this create cash flow in retirement for those of you who are investing to replace your incomes in retirement. One other feature here is we're going to have a fairly robust Q&A discussion today that will also be recorded. We had a number of people submit questions prior to the meeting. So if you do have questions, pop them into the chat box or into the Q&A box. We're going to try to get through all of these. We really don't have a time limit here, but I know some of you do have a hard stop. Like I said, everything will be recorded and put up on YouTube and on our website if you need to go back and review this at any time. I will say one other thing. I think Dominic is having some issues with his camera. So he will be on audio only today. And it looks like Peter's muted, but he's going to come off mute and we're all going to get started here. So remember to pop those questions into the Q&A or the chat box if you have any. So I'll jump right in here. Rising income securities. So Peter, I'm going to start with you on this one. Maybe you could just give us a bit of a backdrop in terms of the importance of having a rising income stream as investors and how this has been a part of our philosophy for many years.
Thank you, Justin. It certainly has been. An important part of our financial planning is that we want to build a portfolio for our clients that will provide a lifestyle sustaining income. And most of our clients in retirement are receiving Social Security and sometimes some sort of a modest pension. But we also want that, but in many of them, the pension sometimes will not grow, where a Social Security will grow at the rate of inflation. But we want to outpace inflation. So that's the reason we want so to allow for a lifestyle sustaining income, we need an income stream that's going to grow. Inflation is the major factor that's working against us over time. It may seem modest at a 3% growth rate, but over time, over a 20-year period, your income needs to double in order just to keep up with a 3% inflation rate. And a heavy part of our investments is in common stocks. And in common stocks, we can benefit by the cash dividend that companies pay us, but also the growth in that cash dividend over time. And naturally, the capital growth we benefit from that as well. So we want to own the portfolios that are going to not only provide an income stream, but are going to grow. So what do we look for in businesses to kind of indicate is the healthy place for an income stream to grow. So naturally, we have to look for businesses that pay a dividend. We also look for dividend companies that have very strong income statements and balance sheets. And an important piece of that also is strong cash flows that will allow for not only a dividend, but substantial dividend growth over time. So a number of blue chip stocks have paid dividends in many cases, 10, 20, 30, 40, and in cases like ExxonMobil, they've paid a dividend since 1881. Now, a company like ExxonMobil will increase their dividend at a much slower pace than, say, a company that had only more recently started paying dividends. So my favorites companies are companies that have very strong cash flows and that have just started initiating a cash dividend. And so maybe we can look back a little bit historically on something like this. For example, one of our longtime holdings is an Amgen. And in Amgen, they started paying a dividend in 2011, and they started out with a 56-cent dividend. But that was only a very small portion of their cash flows, which was $7.35. And then the next year, the dividend grew from 56 cents to 144, and that was still a small portion of their $8.16 in cash flow. And then they jumped to 188 and finally to 244, and that dividend growth has continued. If we look at our current portfolio, one of the exciting companies that I see in terms of dividend growth is AerCap. Now, AerCap did not pay a dividend until 2024, and they paid a 75-cent dividend. But it's really astounding to see that they have $25.56 of cash flow. So there's huge room for opportunity. And that dividend jumped up to 108 this past year when they have $30 in free cash flow. So that's our approach, is to get a growing income stream that's going to offset the pace of inflation. And it's a wonderful tool for those folks living in retirement on the so-called fixed income. Justin?
Thanks, Pete. Hey, Dom, what would you have to add to that before we go into some visuals here?
Yeah, the only thing I would add is the businesses that we look for, sometimes they come with dividends, sometimes they don't. And when we buy a position, we're obviously looking for a stock that's undervalued that we think can appreciate over time. When we view that the stock is significantly undervalued, the company can either pay out a dividend, buy back stock, or keep the cash. When a stock is significantly undervalued, I think we would all agree that the best course of action is to buy back the stock. But as that stock approaches closer to a fair value, we like to see when the capital allocation flips from a buyback to a dividend. And when that happens, I think we get greater confidence that the management team is being prudent capital allocators. And that is typically just the start of a long string of growing dividends.
That's a great point. And we're going to have a chart here later on that kind of illustrates how that's happened and points to some of those names that Peter had talked about. As we were putting this presentation together, I thought it'd be helpful to add some visual context to these comments that have been made. What this chart is that I've pulled up is just a look at the last 10 years of inflation, and each year 2015 through 2025 is posted here in terms of what the percent rate of inflation was. And you can see in 21 and 22 inflation spiked and was quite high. But if we look at the average of this 10-year period, the average rate of inflation was 3.24%, which, Pete, correct me if I'm wrong here, but I think that's pretty consistent with trendline inflation for your 47-year career. Am I right?
It is, but you got to remember that average kind of evens things out. In the late 80s, in the late 70s and early 80s, inflation was at much higher rates, but it cooled down substantially in the late 80s and into the 90s, and of course after the year 2000 as well.
Right. So as we look at, inflation, I think going off the historical average or the 10-year average, if we assume that a 3% of inflation rate is going to persist, which is highly consistent with what we see in the financial plans that we put together for people, what we find is that a dollar, the buying power of that $1, after 10 years of a 3% inflation rate, that buying power drops to 73 cents. And like Peter was saying, after 20 years, it's cut in half. It's down to 54 cents. And for most of us, we're planning for a 30 plus year retirement. The buying power of $1 drops to 40 cents at a 3% rate of inflation over 30 years. So we need a solution. That's the problem. We need a solution that combats that erosion of the buying power of our dollars. And we believe that owning companies that pay dividends, that grow those dividends over time, is one of the best ways to do that. So our rising income portfolio is listed here. I realize the text on this is very small, but Dominic, maybe you could explain what this chart is showing and maybe highlight a name or two here that we want to discuss as a good example of what's going on in the rising income portfolio.
Sure. So this table is an illustration of what we call a rising income portfolio. And to be in this portfolio, you have to pay a dividend. And there's 25 securities in here that span anywhere from your financials, utilities, materials, industrials, basically covers every single industry there is. And what we look for in companies, as Pete said before, is high quality businesses trading at attractive valuations that have clean balance sheets. So that means not a lot of leverage. And by and large, that's what we have in this portfolio. And so I'll use an example that we'll talk about a little later, is Huntington Ingalls. It's a company that trades under the ticker HII. It has 13 years of consecutive dividends and consecutive dividend increases. It operates in the defense industry. It's a high quality company, one that we expect to grow for many years into the future. And when we can find companies in the early stages of paying out a growing dividend, it allows that dividend yield to grow on our initial cost basis over time. So that $2.10 dividend that Huntington paid out in 2016 is now $5.43. And we expect that to continue to grow into the future as their business continues to improve as well.
Yeah, and I'm going to add a highlight here and just blow this up a little bit. If we assumed that of this 25 stock portfolio, you own one share of each of these businesses going back to 2016, in 2016, your income from that one share of that 25 stock portfolio would have been $65.11. And by the end of the 10-year period, it would have nearly doubled to $121. So going back a couple of slides and saying, okay, well, hey, this is the problem. Our buying power of our dollars is declining because of inflation. Over 10 years, $1's value dropped to 73 cents. Well, here we've created a solution where the income from the portfolio has doubled. If that's happening, you're outpacing the rising cost of living. Whether it's your pension, your Social Security, your portfolio, that's the solution that is needed in order to maintain the quality of life that you've had during your working years. So really cool report that Don put together on this. Peter and I, we've been running a similar report for this. Pete, I don't know when the first time we did this was, but the story is always the same. If you own high quality businesses that are paying growing dividends, you will outpace inflation by a handsome margin. Pete, do you have anything to add here? You're on mute. Oh, Peter, you're muted.
Pete.
I'd like to add a little bit. Many securities we want to own for a very, very long time. And so, for example, if we were to take M&T Bank and instead of owning M&T, having a certificate of deposit with M&T, we say that the M&T Bank stock that we own, we call it M&T Bank CD. And, in 2016, it paid us a dividend of 2.80. And then the next year, so it maybe paid us the 3% dividend then. Then that dividend jumped to $3 and $3.55 and $4.10. And so on our original cost basis, we're seeing actually our income stream growing. And if it's a replacement, if we would have had that money into a certificate of deposit, for example, it's a wonderful way to build wealth. And I always use that just kind of as an example of what we're trying to accomplish.
Thanks. So Dom, next I'm going to turn it over to you and just talk a little bit about some of the key holdings in our rising income portfolio and how those overlap with the way we've kind of always done things with our legacy portfolio and where clients see intersection and where the rising income portfolio might have a few differences.
Yep. So the origin, what Peter, Justin built, O'Keefe Stevens on over the past decade is a high quality, more concentrated portfolio. And whether the company paid a dividend or not was sort of secondary to finding undervalued securities. We have over time developed a portfolio that focuses solely on dividend paying companies that we think will increase their dividends over time. And this delineation, while may seem drastic, still has the core principle of we are looking to find high quality, undervalued businesses that we think can generate long-term value over time. And so on the left-hand side, you'll see solely companies that are in a rising income portfolio. These include Southwest Gas Holdings, JP Morgan, Huntington Ingalls, and what you know as UPS or United Parcel Service. On the right-hand side, though, is AerCap, Corning, M&T Bank, and Union Pacific. And those four companies are in both our existing legacy portfolio that we call and also our rising income portfolio. And so we try and find securities that are, again, undervalued. And then from there, we determine, hey, if it pays a dividend that we think is going to grow over time, maybe it's also a fit for our rising income portfolio. And the businesses that we are looking for are still the same, high quality, cash flow generative businesses that we think can compound value over time. And on the next slide, I'll go a little more in depth on what some of these businesses solely in the rising income portfolio do. So Southwest Gas, they're a utility that operates in Nevada, Utah, California. And the thesis is relatively simple. They previously owned a construction business that they spun off. It was called Century and have since sold down the position. And they used the cash proceeds from the sale and spin-off to deleverage and repurchase stock. And we've talked about Sphere Entertainment in the past in Las Vegas and just the overall growth that I expect in Nevada and specifically Vegas, stemming from the switch from primarily a casino to a more destination entertainment focus. And Southwest Gas is the utility provider of the Las Vegas Strip. So any growth that occurs in Vegas, Southwest Gas is going to benefit from by supplying more energy to the Strip. And so the company has a long history of prudent capital allocation and project development, but that was masked by the issues that were at Century that they have now divested of. And so now it's a clean utility story that has a growing market. They'll be able to deploy capital into their business to expand the amount of customers and commercial buildings that they can serve. And the way their business model works is when they start serving more customers, that generates higher earnings, and that'll drive their ability to pay a greater dividend higher over time. So I met with the management team 2 years ago when I went out to Nevada for a Howard Hughes Investor Day. Everything they said that they wanted to do, they have continued to execute on, and they are one of the best management teams in terms of they keep their operating costs low relative to the number of households they serve. Next is JP Morgan Chase, probably a well-known bank. In my opinion, it's the greatest bank in the world, led by the greatest CEO, Jamie Dimon. It's a high-quality, overcapitalized bank, which means should the bank ever run into credit issues where people can't pay their loans or corporations can't pay their debt, the fact that they're overcapitalized means it's not going to impair the business. And this is a key metric that we look at. And so because of this, in 2022, they were able to buy First Republic Bank for $10 billion because of the bank issues First Republic had back then on the deposit runs that they were experiencing. And they paid $10 billion for a company that was worth over $30 billion just a few months prior. And it's a brand name asset out on the West Coast. And because of their great capital allocation and prudent leverage, they were able to be one of the few buyers that were able to take advantage of this situation. On top of this, when you're the largest bank generating the highest amount of earnings, unsurprisingly, you can invest the most in technology. And I suspect they will be the leaders in AI on the financial services side. And case in point today, their asset and wealth management division that manages over $7 trillion announced that they internally developed an AI tool that will allow them to vote on proxy contests. So this is every year a company puts up nominees for their board of directors, management compensation, accounting firms, things like that. And historically, the voting of this is outsourced to companies called Glass Lewis or ISS, and JP Morgan would pay these guys a fee. Now that they've internally developed this tool, they can basically automate the voting of proxies, which will over time save them money. And so while JP Morgan never really screens as a cheap company, they're a company that has grown earnings north of 15% every year, repurchase stock, and they have a really healthy balance sheet, again, operated by Jamie Dimon, one of the best CEOs out there. And so it's been an attractive investment for the past couple of years. And then finally, Huntington Ingalls, which I'll discuss in more depth on the next slide, is a defense contractor. They primarily build Navy ships, things like aircraft carriers, destroyers, and submarines. And so, Justin, if you can go to, oh, sorry, thanks. So they're a company that we think displays exactly what we're looking for. It's a high quality company that goes through or went through a short-term issue that once they worked through it would allow investors to see how strong of a company they are and what the prospects are in the future. And so in 2014, Huntington has a large backlog of ships that they have to build. And you can imagine a submarine, an aircraft carrier does not get built overnight. So they have to price out the cost to build these ships many years in advance, sometimes decades. And they price them typically on either a cost plus method. So if it costs $1 billion to build, they may take a 5% margin on it. So they get, $1 billion, 1.05 billion, something like that in revenue. Or they'll operate under what's called a fixed price contract, where they say, we will charge you $2 billion to build this ship, and we are on the hook of any price increases, or if prices decrease, then we get the net benefit of it. In 2024, Huntington was working through a backlog that they had contracts priced for in 2017 to 2020, prior to the significant increase in commodity prices. And this led to Huntington taking a charge because steel prices went up, lumber, copper, all the cost of basically everything, employees went up, and it went up greater than what they were expecting and built into the contract. And therefore, the profit margin that they thought that they were going to make on the ships was not such. They had a 7.5% margin in 2023, and in 2024, it declined to 5.5%. And while 2% may not seem like a lot, it's around a 20% decline in operating margin, which is a significant drop. And investors, when that happened, are concerned that maybe the 7.5% margin wasn't the right number. Maybe it's 5.5%. And if you run that through any sort of analysis, it results in the value of the company being a lot lower. Fast forward to today, company has now announced different initiatives to expand margins to 6% in the near term, and likely by the time that we get back to 2030, margins are likely going to be north of the 7.5% that we experienced beforehand. So if you couple margin expansion over the next several years, combined with all of the initiatives that are ongoing at the government level, they've talked about building a new aircraft carrier for the first time, I believe, in several decades, and they're trying to revitalize, improve the Navy. This will all lead to growing revenues, earnings, and ultimately their dividend over time.
Oh, thanks for that, Dom. And if anybody has any questions about these positions or any of the other positions in the rising income portfolio, throw them into that Q&A box. I'm going to tie this all up so we can get into Q&A because I know Carly's got a long list of questions to fire at us here. But I wanted to show just one more visual, and it's one that we haven't shown in a while. Many of you have seen it, but there's some new people on this call. And I really just want to talk to how we devise a cash flow plan for people in retirement and talk specifically today about how dividends are supportive of that. So we look at this simple graphic here. This black line, it kind of shows us what market returns are like, right? They go up, they go down. We do know that in the long run, they produce positive output, right? But this is why it's important for us to keep cash reserves in our portfolio. And so for somebody who's in retirement, that cash reserve might be anywhere from 1 to 3 years of liquidity to support their near-term needs. Today, we're going to talk about this in the Q&A section. Our cash reserves are a little higher than that based on some sales that have happened over the last year. But what we want to attempt to do is have that cash reserve consistently being replenished. And what we would like to do is have dividends constantly coming in from the portfolio to help replenish that cash reserve. And we also want to take from the portfolio when times are good, like they have been for the past few years, and build that cash reserve up when times are good, so that when we do have down markets, we have a stop of let's reinvest dividends, let's use our cash. And what we are attempting to do is create a capacitor with that cash reserve so that we can create growing retirement income that is consistent and reliable from the portfolio. So dividends are an important piece of that, and also having that outsized cash position when times are good, and then living off that cash when markets go down. It's all part of the integration of good investment management and having a routine financial planning conversation with our retired clients so that we're all on the same page, we're anticipating when income needs are changing, and we're accounting for it within the portfolio. It's not just a plug it in and one size fits all solution. Everybody's needs are different. So just to summarize here, dividends, they accumulate and add cash reserves in clients' portfolios. It helps us provide more predictable outcomes. We didn't talk about this, and it's not in the slides, but Pete, we were talking about it earlier today. In your experience, you made a comment, dividends also help provide some downside protection. Would you agree?
Absolutely. Excuse me, when we have difficult times, you continue to have those and it stabilizes the value of the portfolio. While we don't consider the volatility of a portfolio as risk, it can be very disturbing to clients when we do have that volatility, and the income stream that's coming in helps modify the downside on portfolios.
Great. So with that, Carly, I'm going to hand it back to you. Those were the prepared remarks here. I know we have a number of questions that have piled up in the Q&A box. So why don't we start with the pre-submitted questions, and if more questions roll in, we'll take them as they come in.
Okay. So yes, we did receive a few emails with questions before the call, so thank you for doing that. Again, if you ever have a question you want to submit to get answered on any of these calls, you can feel free to email me, Justin, Dom, Peter, really any member of our team, and we'll make sure they're addressed. The first question that we're going to answer here is, what is the outlook for PRGO, which I believe is Perigo?
Yep, I'll take that question. And Justin, if you can go to the next slide, I have a little chart and email I received this morning. So Perigo has been an underperformer relative to what we expected. They have a U.S. business that is primarily on the cough, cold medicine. They are usually generic drugs. So if you go to like a Wegmans, Walmart, Walgreens, something like that, and you see their branded generic drugs, typically Perigo is the one that is manufacturing and fulfilling those subscriptions. 15% of Perigo's business is tied to, well, basically the cough, cold, flu season that happens in the beginning of winter and basically lasts several weeks. And last year's flu season was at the highest rate at one point, but on average, I would say it was more of just like a mild to average year. This year, the CDC has come out and said this is the worst cough and cold and flu season they have seen in, I believe it's 33 years. And when 15% of Perigo's business is tied to this, you should naturally see higher revenues from those segments. So from that standpoint, we have a natural tailwind. What happened last year, they had operational challenges. They underperformed relative to expectations. They got kicked out of one of the indexes, which we've seen with Compass Minerals, what the impact of getting removed from an index can do. So on top of having a poor business environment, they then had it compounded by the stock getting kicked out of an index. Today, they are looking to divest some of their non-core businesses. They have a derma cosmetics business that they've already agreed to sell to a private equity firm that's getting sold for around 300 million euros. They have an oral care business that they have announced that they're looking to divest. And then one of the initial theses behind investing in Perigo was the recovery of the infant formula business. New regulations came out that required certain changes and modifications to their existing manufacturing footprint. They went through most of this, and then when they came out, the environment was not the same as when they were one of the leaders in the space. Competition increased, the cost to maintain these plants increased, and during the downtime over the last year or two, when you get a child on a formula, you're unlikely to change what formula they're on. So they have a couple year period where just like the demand for that infant formula is less, and they're now looking to divest that business as well. So where we go from here is we would like to see them sell those three businesses. I'm hoping that can bring in around $1.1 billion of proceeds, and that will allow them to reduce debt from $3 billion to around $1.9 billion. Right now, leverage is the concern with the company. When earnings and revenues are declining and you see a debt load, people look at what the balance sheet has, and it's not the cleanest balance sheet. But if they can reduce debt, and we see a path still for them to generate $3 in earnings, it's not going to happen in 2026. It's possible that it can happen in 2027, and it's still a high quality consumer business that can trade anywhere from 10 to 12 times earnings. And again, that gets you to a $30, $36 stock. So the stock at 14, 15 today still looks very attractive. One thing you'll notice, we have not added to the position, and the reason for that is thus far the thesis has not been correct, and our philosophy is if it's not correct, then we need to see a path for it to get back on track before we start adding to the position. And while that appears to be that appears to be in the cards. I think we still need a little more clarity before we start adding to a position that has significantly underperformed what we expected.
Thanks, Dom.
All right, so we did have another question on Perigo, but you did answer it, so we'll skip that one. The next question I'm going to go to is, how do you view NVIDIA's $110+ billion in investments in other companies during 2025 and the planned $20 billion in Grok in 2026? How does this bode for shareholders? Pete or Dom, you want to start?
Dom, why don't you go ahead on that one as well?
Sure. The $110 billion is not a figure that in 2025 or 2026 they are going to make $110 billion of investments into other companies. That $20 billion of that they're signing a licensing agreement with Grok, that is $20 billion out the door. But a lot of that remaining is basically a financing transaction with OpenAI, where NVIDIA is going to basically hold a note of some sort that will allow OpenAI to buy NVIDIA's latest GPUs so they can use and train their models. The seller financing, I'm going to guess Pete has more to say, because that was, I believe, one of the big issues that occurred in the tech bubble. I would say I am not concerned today about the investments and the financing arrangements that NVIDIA and AMD and other players are making, because I don't think the scale it's being done on today is a cause for concern. When you've got Google, Microsoft, Amazon, these incredible businesses that still generate high free cash flow, that those are the main purchasers of this technology still. Until we see more and more debt or these seller financing transactions entering the market, I'm not going to be worried. When they start entering the market, that's when I think I'll be concerned.
The only thing I would add here is the amount of new IPOs and the valuations in some of those second and third tier artificial intelligence business is definitely of concern to me.
Okay. The next question that was submitted prior to the call is asking if the team can speak to the heavy cash positions in accounts right now. So they understand that we want to have cash on the sidelines to deploy when there's good opportunity, but feels like maybe we're missing out on some growth the last few months.
Pete, why don't you start, and then I have some things to say about that as well.
Sure. When it becomes harder and harder to find things that are a good value and things appear to be overvalued, and you decide to put some money on the sideline, much like Justin had mentioned with the capacitor, so we have adequate cash reserves for the future. The market does not say that O'Keefe Stevens is selling, that therefore we need to decline. It can continue on for an extended period of time to go to higher levels. But when we see things that we believe are a good value, we'll add to those positions. And of course, when we had the experience of 2020 and when the market dropped off dramatically, none of us saw that coming, but it provided a wonderful opportunity for us to add to businesses that we just loved. And had we not had excess cash on the sideline, we would have totally missed that opportunity. And that will happen from time to time. You never have perfect timing. It just doesn't happen that way. Certainly, we would love to have perfect timing, but the markets are not always accommodating to my thought pattern or anyone else's for that matter. So, Justin, do you want to add to that?
Yeah, well, as we just went through our fourth quarter reviews with clients, and as we looked at the certainly the performance for last year was outstanding, but I would pull up the numbers of what the performance had been over the last 3 years. And it was staggering. In many instances, we've seen portfolios values nearly double in those 3 years. And we're looking at this as a situation and saying, hey, we're meaningfully ahead of where we ought to be in terms of the plan that we put together. And if you go back to that slide, I can go back to that slide where we look at the ebbs and flows of the market. It's consistent with everything we've said we would do, that as markets are going up, we're going to peel off a little bit more money and have that extra cash on the sidelines so that when, not if, markets decline, we know that we have the ability to provide that consistent, reliable output for people in their retirement years. Now, for people who are not in retirement years or who are in retirement years, today, markets have gone way up. We have outsized cash positions. What Peter said is exactly right. When the next big event happens, and it's not a timing call, it could be 2 weeks, 2 months, 2 years from now. We don't have a crystal ball. What I want to be able to do is pick up the phone and reassure you that this is part of the plan. And because we have 4 years or 5 years of cash reserves set aside in your portfolio, when the market goes on sale, that's the time to back up the truck. So why don't we take a year or 2 years of that cash and start to drip it back into the market? That's how you recover more quickly from big market downturns and how your portfolio's results improve over time, despite having big declines in the market. So that's why we're doing what we're doing. It's not, there is no perfection here. We're just making prudent decisions based on the information that we have today.
We had a wonderful example of that of a security we sold earlier this year, which was the Tanger factory outlets. We had bought into Tanger at about $25 a share, and then in 2020, that stock dropped precipitously and traded as low as under $5 per share. And so in many cases, we doubled and tripled and quadrupled in some cases the client's position, and we sold that out earlier this year at about $36 per share. Earlier last year, I should say. And so the person who bought it at 25 and sold some at 36 did well, but where we really made our money was in the stock that we bought at $5, $6, $7, and $8 and $9 per share and sold out at 36 5 years later. In addition to reaping dividends along the way as well.
That's a great example. Thanks, Pete.
Dom, I see that you want to say something there. Go ahead.
Yeah, I have a couple things. One, we sold 5 securities over the past, call it 6-7 months. 4 out of those 5 have declined relative to where we sold them. Capstone is the only one that increased, and even said that based on where we bought Capstone to where we sold it was an outstanding investment. And then the other thing I wanted to say is and Pete touched on it, it's sort of like an opportunity cost equation that you have to run. When a market declines, it doesn't matter if you're a good business, bad business, okay business, correlations, everything goes down. And when everything goes down, the good businesses go on sale. Rarely when the market is going up, do good businesses get exceedingly cheap. It is at times better to have that cash on the sidelines where you can immediately deploy it into these high quality businesses where the market may not give you an opportunity for a long time to make that purchase. Whereas if we had to go into the portfolio to sell down one position to buy another, there is some friction in that transaction.
If I was to summarize, we want to take a swing when the pitch is fat and down the middle, and every once in a while we have a market event that makes it very obvious to us. It's not easy to do that. It's when everybody else is panicking, but historically we've maintained our behavioral discipline and our focus. And as Pete mentioned with Tanger, it's worked wonderfully for the people who've stuck with it. Carly, what's
Right.
our next question?
Sure. The next question is related to performance and our performance versus various benchmarks like the S&P over a few different time periods. If anybody wants to speak on that, I think it's been touched on a little bit, but
I actually don't want to speak to it. As a matter of principle, we put a plan in place, and the only benchmark that I am really concerned with when I get together with anybody on this call or anybody who becomes a client on this call is, are we on pace with your benchmark of what it means for you to be successful financially? The way that we've chosen to invest, I feel highly confident that we will exceed that benchmark if you're patient and you give it time. But to compare ourselves to the S&P or the NASDAQ or the Dow is a fool's errand, because the portfolio that Peter and Dominic put together for you looks nothing like those portfolios. We are very eccentric and unique in the way that we build a portfolio. So to measure ourselves against an index is not the right proxy for, are we successful in your portfolio? Pete, what would you say?
I'm in my 46th year, and I've always been very reluctant to talk about performance of a portfolio in meetings with clients. And because I believe it sends the wrong message to you. Just as you said, it's really, are we on track with your financial plan? I believe that the philosophy that we follow over the years has produced outstanding returns. If I'm constantly talking about performance with you, the chances of panicking during difficult times are just far too great. And really the major role that we play in the lives of our clients is that as of a behavioral coach. And when you're constantly talking about performances, you send the wrong message to the individuals who you're coaching.
That's spot on. Let's go to the next question, Carly.
all right, thanks guys. The next question and the last one that is a pre-submitted question is, I'm looking for some insights into Qualcomm. I would have expected better performance in terms of stock price when looking at the market it's in. Is this performance in line with your expectations?
I'll address that. Much like all the investments that we make, we buy things when they're unloved and unwanted. And that was the case when we originally purchased Qualcomm back in 2017. And Apple had stopped paying royalties, Huawei had stopped paying royalties, and the Obama administration hit them with an antitrust suit. So we really had got hit by 3 pitches in a row that were three big slugs to the stock price, and it dropped it off dramatically. Yet they had a long history of paying terrific dividends, and so we were buying at a significant discount to what we felt the company was worth, and also had a great dividend while we were waiting. Those issues have all cleaned up. I attended the Qualcomm Investor Forum last year in New York City, and they outlined what their plans are for the next 5 or 6 years. They expect to grow dramatically in automotive, which they are, in the Internet of Things, which are like the goggles and eyeglasses that folks are wearing. They've also entered the CPU market and are taking on both Intel as well as advanced micro devices. But a big piece was Apple is becoming less of a client because Apple didn't want to pay for, they did not like the structure of how they were paying for chips. They still pay royalties to Qualcomm. I'm somewhat disappointed relative to the tech sector and how it's performed. But once again, the markets don't always perform the way I would like them to. But it's a wonderful, solid business with a great management team that has a long history of delivering on their promises and has outstanding technology.
All right. So that was our last pre-submitted question. So I think we'll hang around for a couple minutes. If anybody wants to last minute get their question in, please submit it through the Q&A or the chat. We'll hang out for a couple more minutes. If no one submits any questions, then we will end the webinar, but we'll just hang out here on mute for a few minutes and see.
Carly, let me add a little bit to my discussion from earlier.
Sure.
If we go back to earlier in the decade, or I'm sorry, earlier in the go back about 10 years, Justin and I were accumulating positions in Corning, and Corning, we bought some at 17 and 18, and then it went down to 15, and we added to it again. It went down to 13 and 12, and the conversations that we would have with clients very often is, what's wrong with Corning? And we would say there's nothing wrong with Corning. As a matter of fact, it would make sense to add to your position because we think the long-term prognosis of their technologies in fiber optics and in the size of television screens growing, and the amount of money they put into our research and development and the long history they have of coming up with creative products make it for an outstanding business. Well, that question is no longer asked to us as Corning has taken off, especially in the last 6 months. And now we're at the point in time where we say, we have an oversized position in Corning. Should we be taking some off the table so that it's more in line with the rest of the portfolio? It's just the very nature of when you look at a portfolio, you look at whatever is down and you say, well, what's wrong with it? And very often when the price of something declines, that is exactly what is right with it. And it's a wonderful opportunity to add to that position.
I certainly don't want our portfolio positions to go down, but as Pete was saying, we're high conviction investors, and we get to know these businesses. In many cases, we know the management teams of these businesses. And I actually view that when the line of questioning is going up and up, whether it's about the whole market in general or about specific positions as a portfolio, it's an internal indicator to me that something is becoming expensive. And certainly not going to base all of our purchasing decisions off that small piece of anecdotal evidence, but it is a factor that I consider, as if everybody's talking about how down and out something is, it might be worth taking a closer look, because very often the contrarian viewpoint is where you buy something at the best price possible.
Great, thank you both. I don't see any questions submitted in the Q&A or the chat, so I'm figuring that everyone's had their chance to, and we just don't have any more questions. So I just wanted to thank you all for joining us. Thank you, Justin, Dom, and Peter, for all of your insight. This meeting was recorded, so it'll be up on our website soon and our YouTube page, and a recording will also be sent out tomorrow via email. Our next call will be the first week in April, so look out for an email from us regarding that registration. I usually send that out about 2 weeks ahead of the call. And again, thank you for joining us, and you can always submit questions to me ahead of time if you need to. Thank you, everyone.
Thanks, everybody. Happy New Year.